solo one disappeared. Didn't you try to delete the one?
No. Okay, Zachariah, since we're the only ones in the room, I'll just give it a few minutes just to see if we have any other people to join, and then we'll get started because we don't want to waste your time either. Hey guys, let's get started. So I'm going to just give you a quick overview of how the challenge is going so far, and then I'll hand over to our finance expert, Michael Grobler. All right, so overall campus performance. Currently, profit-wise, VC Online has the lead. VC NMB is in second and Santon in third. Okay, so we are looking quite good. That's a substantial profit margins so early in the game. Here are our top 10 from our online participants. Congratulations, guys. Those portfolios are looking great. And here we have our campus participants and our top 10. Again, very profitable, very early on. Well done, guys. Just a reminder, phase 5 starts in August, so you will receive an additional $500,000 of virtual trading money to invest in the Dow 30. Then we hit phase 6 in September and October, where you are required to maximize your profits and finalize your portfolios. Now that we're through the challenge overview, I'm going to hand over to Michael to give you an overview of what's been happening in the market, specifically related to the Dow 30 shares. Okay, Michael, you can take over.
Share the screen.
Okay, hi guys and girls. We're just gonna sort the audio. Okay, so we're not going to do anything too philosophical today. We just want to do sort of a rapid fire rundown of all the basket constituents that you guys have access to on this competition, which is the Dow. Just a basic history of the Dow. The Dow was it's basically just a thought experiment that a guy by the name of Charles Dow and his business partner, Edward Jones, came up with. They were both journalists in the early 21st century, and they in the early 20th century, and they decided that they needed a way to track the index more broadly, because people were looking at individual shares at the time and they weren't really quite understanding whether or not the overall market was moving up or not, because there were so many nuances to each individual share. So these guys just came together and they created the Dow Jones Industrial Index, which originally was comprised mostly of industrial companies, obviously, but today it's comprised of a number of different kinds of companies. Big companies, always very large, always 30 of the largest, not always the 30 largest, because there are certain enormous companies that can't be included, but for various reasons, like Berkshire Hathaway. But these two guys, actually very impressively, they also started the Wall Street Journal. So that's kind of their claim to fame. And then they started to put their little index on the Wall Street Journal, and it became a thing. So all we really want to do now is just give you a general idea of where every company is on the Dow 30. We'll start with Apple, but we'll do it from we'll start with software and technology, and then we'll move through the different sectors or subsectors that are in the Dow, like consumer goods and retail, etc. Financial services, healthcare, pharmaceuticals, industrials, and materials. So starting with Apple, we've got I just want to put my phone on silent. My apologies. So Apple's had a hard time recently because it's suffering from a lot of tariff worries as a result of Trump's sort of making use of tariffs to negotiate new trade deals, etc. Now, China has about 80% of iPhone production in one factory. So Apple outsources almost everything that they do to China as far as the manufacturing goes. It's really just the designs that take place in America in some of the most impressive facilities in the world. Incredible business, but it really is one of the worst performers on the American index over the course of the year as a result of that. And as you can see, it's been a very good performer over the years, even after Steve Jobs left. The company's really soaring. And then also Warren Buffett had a large percentage of his overall wealth in this share for a very long time as well. So he made a fortune out of this move, but he actually recently sold a very large amounts of the share. And Choose Bobbitt just goes off a cliff as soon as he sells it. That's why he's Warren Buffett. Yeah, so you can see perhaps it's re-entering its trend line. Just a second, sorry guys. Okay, so yeah, obviously a general idea of Apple. They're a multinational technology company that designs, manufactures, and markets consumer electronics, software, and online services. The flagship product is the iPhone, the iPad, the Mac, and the Apple Watch. Now we're going to move on to Microsoft, which is also a Dow component. It's a leading global technology company that develops, manufactures, licenses, supports, and sells computer software. It has been performing extremely well lately. It's forming part of the AI revolution stock, so it's kind of got that theme behind it at the moment. And as you can see, yeah, especially recently, it's experiencing a bit of a parabolic move higher. So the question is, do you buy this stock assuming it's going to continue to the moon, or is the move already overextended? One thing about Microsoft is they're probably the most structurally dominant company in the world, with the possible exception of Google. I mean, if they take away your licensing rights, you don't have a business. So they really have a complete monopoly on, especially office related and like SMME, corporate, everything there. They're so well integrated into the system. They'll likely thrive for many years to come. The question is, in the short term, has the company run a bit hard, or looking at the overall market, it is a leader in the market. Will it continue to lead? Now, in the old days, we had totally different companies in the Dow because the Dow changes over time, the components thereof, or therein. So here we have one called Salesforce, which is a cloud-based company. So obviously when Charles Dow created the Dow Jones Industrial Index, there wasn't a Salesforce providing cloud services. This company has performed very well over time, but has also suffered recently in a similar way. You'll notice because everything is swimming in the same ocean, which is the American market, you'll find a lot of similarities between these charts. You'll see that the recent price movements of all three companies we've looked at, well, two of the three companies we've looked at are quite reminiscent of one another. So a rising tide lifts all boats. unfortunately, if the market starts to come down, you know, you're very likely going to go down with it. The hope is that you will go down less. So remember, this is a competition. It's a matter of outperformance, not absolute performance. So, I mean, there are markets where everyone in the entire competition could lose money, but someone will lose the least. That will be the best trader. That's kind of how you approach markets. So don't judge yourself. If the market's crashing and you're losing money, I mean, you know, but at the same time, you know, you're not necessarily a genius if it's a bull market. So you've got to always see it in the context of the flow of the overall market. Salesforce has suffered a lot lately. You can see here these recent movements on the market are from the earlier in the year when there was a lot of tariff panic. You will see that most charts exhibit this movement as a result of that. Some of them have recovered very powerfully from it. Some of them have not recovered at all. Salesforce is a cloud-based software company that provides customer relationship management, CRM services, and also sells a complementary suite of enterprise applications focused on customer service, marketing automation, analytics, and application development. So you see a number of these kinds of businesses in the world at the moment. They're some of the most prominent businesses in the world. They're relating to cloud, AI, internet security services, systems integration, marketing automation, companies like CrowdStrike, companies like Palantir, who have the job and the contracts of optimizing the US military's strategic, tactical, logistical, and every other conceivable facet of the American army is now optimized by private companies that provide this service by using software to essentially cross-reference information and derive efficiencies from that. So, I mean, imagine living in a world where some militaries are doing that and others are not. So it's like dinosaurs don't have a chance scenario. They have a very big impact, these companies, on the military, on government, on the way that government runs, and all the different roles that government plays, healthcare, grants, this kind of thing, Medicaid. They are optimizing all of these different systems using new technologies. And as these companies become, because they add such unimaginable value, they quickly ascend into a position where they can enter large indices like the Dow or the S&P 500. For example, Robinhood, which is another large American stock that's a financial services business and a trading house and all sorts of other financially related stuff. They're about to enter the S&P 500. And I mean, they've only existed for a few years. So it's really not about how old you are or how long ago or whatever. It's just about how much value you add and how quickly you add it. Then we have Cisco Systems. Now, Cisco Systems is more of a previous generation kind of company, but you can see here that it's also doing very well. It provides networking technologies that support the other companies in the Dow. Essentially, you'll find that most of the companies in the Dow's primary customers are other companies in the Dow. So, for example, NVIDIA's primary customers are Amazon, Meta, Apple, that kind of thing. So it's to a large degree a large beast that feeds itself and adds new optimal companies over time as these services come into existence in the real world. And also, every time you add one, you have to drop one. So some technology becomes redundant. There was a time when most of the companies were railway companies or some irrelevant utility of some sort that we no longer consider even worthy of having on an index. Yeah, like Telkom was a good example of that. You had a company that, if it didn't manage to pivot into mobile telephony, they wouldn't be selling us ADSL lines like they were 10 years ago. They'd have no business. They actually did manage to do that out of interest, and it was extremely impressive. So now they are essentially primarily a mobile service provider. Cisco is a global technology conglomerate that designs, manufactures, and sells networking equipment, telecommunications equipment, and other high technology services and products. So obviously, especially now with the new AI boom and the number of server farms that need to be built and cloud warehouses that need to be built in order that we can process this. We need enough compute to actually process all the questions going through the AI, and also to allow the AI to do more with less time. And Cisco provides services into this to an enormous degree. And as you can see, it's riding the coattails of this theme at the moment. They say if there's a gold rush, you mustn't try to find gold, you must just sell spades. So these guys sell the spades, and companies like Meta and Amazon and X are all trying to use that technology, that hardware, that physical stuff to power their software. Then we have Intel. Everybody knows about Intel. Intel Inside, you can see the chart has gone in a totally different direction for this one. So why did it go in a different direction? So what happened a long time ago was everyone in the industry of microchips came to realize that it was impossible to run a business that was both a specialist in design and a specialist in manufacturing. So companies like AMD and NVIDIA decided that they were going to become specialists in design, and they were going to give up manufacturing completely. Now, how do they do that? The same way Apple did it. You just outsource it to some Asian manufacturer or something. And then you can get the big brains to America, and they can sit and think about quantum mechanics and build you fantastic chips. But without the distraction of a large labor force and loud machine in the background. So that's what AMD and NVIDIA did. Then company like Taiwan Semiconductors or Nova Nordisk, they went the other direction. They said, okay, we're just going to do the foundries. We're just going to make chips for these companies that design chips, but we're not going to try to design chips. We're going to just focus our resources on making really awesome factories. And they did just that. But this one, Intel, they decided, no, we can do it all. So they went both directions, and they failed dismally. So now they have to pivot back to the one or the other. likely design, but time will tell. However, because they are in this position, even from a price point perspective on the chart, on the price action, this one is an opportunity, potentially, because not only is it quite highly sold off, but it has a potential catalyst for share price movement on the upside. If the share price or the share price would react positively to any successful achievements in the direction of picking one or the other, or alternatively fixing the broken combined model. Whether or not it works, who knows? But that is a dynamic at play in this particular equity. So Intel is a multinational corporation and technology company that designs and manufactures, you see that's the problem, designs and manufactures semiconducting products, primarily microprocessors. Also, a bit of nuance on the AMD and the NVIDIA. Why did AMD run so hard when NVIDIA didn't run hard? Oh, why did NVIDIA run so hard when AMD didn't run so hard? So even inside the focus of chip development versus manufacturing, in chip development, you can develop two kinds of chips. You can either develop general microprocessors, which are the kind that's in your computer that just does the general stuff, but it doesn't do it in a very effective way because it does such a broad number of things. Whereas GPUs, not CPUs, GPUs are dedicated resources. They do one thing really well, but they could never run your whole computer. But what they can do is they can like process Bitcoin code, or they can specifically try to render this thing on a computer game. And they can do that many times more efficiently than a CPU. But a CPU can run your operating system on your PC, but a GPU could never do that. So NVIDIA decided to focus on GPUs and AMD decided to focus on CPUs. And what ended up happening with the whole AI revolution is that those big server farms, they didn't need the chip to do anything except one thing, which is think about that specific AI's question kind of thing. So their sales of their GPU division spiked tenfold. And because AMD didn't have a meaningful GPU sort of offering at the time, they hadn't put enough research and development into it, they completely fell behind. Not nearly as far behind as Intel, but there you see how strategic decisions at board level at early stages make all the difference in the future. But there you see how important management is. Because even if you've got the best CPUs in the world, it doesn't matter if GPUs dominate the investment world at that moment. There was a time when Microsoft came out with Windows and suddenly everybody had a desktop PC that needed a CPU. Then CPUs were the biggest things in the world. Now everyone's already got a desktop PC. Oh yeah, there's the dot-com bubble in the 2000s, just so you know. Crazy stuff. Go back to Microsoft. Now, here's the thing about Microsoft. What you're actually seeing here is the same movement on both positions. However, because you have to see this at the correct aspect ratio, that huge spike that we saw on Intel just now equates to just this movement on Microsoft, because while Intel came down and never really recovered its losses, Microsoft went on to literally conquer the world. I mean, look at this. Unbelievable. So yeah, that's a real success story. But the question is, you know, so you're in your 20s, 30s, late teens if you're a particularly smart kid. You want to enter your investment career at that point in the Microsoft chart. You've got to ask yourself a few questions. So I know these shares are extremely great and popular and everything, but you are really an investor and you are trying to buy an asset that will give you a long-term forward return. So it's not just about what you buy. It's very much about when you buy it, because you can buy a really great company at a bad price and it's a bad investment. You can even buy a bad company at a good price and it will be a good investment. Just something to keep in mind. Now we go to IBM. Let me just find IBM here. Oh, sorry, the screen is. There we go. Okay. IBM. So everybody knows IBM. It's actually called International Business Machines. You can see there they're not exactly struggling. You see how well the market's been doing lately. Isn't it unbelievable? I mean, look at the trajectory of this price movement. Since COVID, markets have just skyrocketed. I mean, you've got a company that's existed since 1981, and it's probably doubled in price since 2023. So the market's recent performance has been absolutely exceptional. And it's very important to remember that that is very likely not sustainable in the very long term. IBM is a global technology and consulting company that provides integrated solutions and services, including cloud, cognitive computing, and cybersecurity. NVIDIA, we're going to move on to NVIDIA Corporation, which is an extremely popular stock at the moment. Okay, so we've already discussed NVIDIA a little bit. IBM is another company that provides systems and computers into this theme, and NVIDIA is yet another. Now, NVIDIA had this share is probably the most spoken about stock on the stock exchange. It has been for the last couple of years as a result of the GPU dominance they've exhibited over time. They had an absolutely epic fall here at the end of 2024. That was the result of the release of DeepSeek, which was a Chinese AI, which was able to compete with ChatGPT quite easily. Only it had been produced at a fraction of the cost and with a fraction of the resources that ChatGPT had required. As a result, the market took that to mean that the infrastructure requirement in the future would not be as substantial as what was previously forecast. So NVIDIA's forward earnings projections collapsed and the share price fell. Later on, after a very substantial fall from 150 roughly to 100 or down to 90, the market sort of recalibrated its thinking, and the overall market went into quite a strong rally. And as a result of the fact that NVIDIA is quite a leading stock in the market, it did just that and it led the market higher. Although its annual performance is far below that of some of the other stocks in the market, since, as you can see, it's only just now managed to recover to a break-even point had you bought at the beginning or the end of, or the beginning of this year or the end of last year. But Nvidia is, this is almost $4 trillion, this company, so $4,000 billion. Quite an amazing business. Started, co-founder of the business remains its CEO. Ironic, his cousin is the CEO of AMD as well. So it's just a whole family business there. Imagine those holiday dinners, yeah. Yeah, it's an amazing business, Nvidia. But we're going to see, can it sustain this? You know, you can see by the performance of some of the different business units in the different regions and the different players that you can see which shares some of them probably own. Remember though, like Mohini said, you must bank your profits by the end of the game, and don't be shy to bank from time to time. You know, you can't go broke making a profit. Okay, so NVIDIA is a technology company known for designing graphics processing units, GPUs, for the gaming and professional markets, as well as chipsets for mobile computing and automotive markets. They were recently added to the Dow, replacing Intel, which is now being kicked out of the Dow, but don't worry, from a perspective of this competition. And there you can see, I mean, if that's not a testament to, you know, moving on and how things change. You've got NVIDIA, a GPU and chip and CPU chip producer, replacing Intel, which at one time people thought was the most cutting edge company in the history of the world. So now we've covered technology and software. We're going to have a look now at consumer goods and retail. Just 1 second for me. Okay, so everybody knows Amazon. Jeff Bezos, guy who gets his furniture into his house using a crane. Recently married, God bless him. Okay, so Amazon hasn't done as well, or it's certainly done as well in the long term, but its recent price movement here hasn't been exceptional. It has done fairly well in the recent, but it hasn't broken through to new highs, anything close to what you're seeing in NVIDIA, etc. The reason why, you'll see here, notice how as we change sectors there, you are obviously in the leading sector. We started with the leading sector in the market. So now think about this. If you're a terrible trader, but you picked anything that we spoke about in technology and software, anything, you'd be up. 80% of the work is picking the sector you're in over the long term. Because if you were a fantastic trader and you were completely the best trader in Walmart and Coca-Cola, and you were like the best trader in Nike in the whole world, you wouldn't have performed well as a guy who just bought Apple or just bought Microsoft. So be very mindful of how sector allocation, especially in the longer term, can have a very big impact on what you're doing. Why do I say that? Because if you buy the technology companies now as a long-term investment, will they necessarily be the sector you want to be in next year? Or do you want to try to be in a different sector that maybe hasn't performed as well and has a chance to have its time in the sun? That kind of thing. Anybody could have made money buying tech and software on the US market, throwing darts on a dartboard. Then you want to decide, okay, so it's now not about winning, it's about being better. So now you want to choose the best technology company that's going to make the most money. Okay, that's cool. That's nuanced. That's where you're reflecting on your different options. You're focusing, you're trying to differentiate between which one's going to outperform. So it's called alpha. So let's say the sector goes up 10%. You want to go up 11% or more because you want to get alpha over the market. You want to be outperformance. So a good way to get alpha over the broader market is just to pick the right sector of that market. And even more importantly than that is to stay away from the bad sector in that market for that period. Because even if you just avoid the bad one, whichever one was the worst, maybe it was energy. If you just don't have any energy shares, then you'll be fine because you don't have this anchor dragging you down. And if you buy anything in tech, you're making money. Whether or not that's going to be true in the future is unrelated to that. But for now, you can see there, any guy could have just randomly bought and he would have been very well off. Then consumer goods and retail. Now, they've suffered a lot more as a result of the political stuff that's going on, as well as, you know, all the wars and all the real life stuff. And even Bezos's shenanigans and all of these things, they affect the share price, just like Tesla's share price is heavily affected by Elon Musk's activities. So this company is obviously a masterwork. They've made some incredible changes lately. For example, they just hired their 10 millionth machine, or their millionth machine, versus a person. So now they have a larger robotic workforce than human workforce. They have fewer employees in Amazon now than they did, human employees, than they did 4 years ago. And they do maybe 3 times the revenue. So that's just scary stuff. I mean, if you think about it, that is seriously scary stuff, because they are trying to price out the human workforce who phone in sick and complain about their dogs being dead and stuff, and they're just not interested. So if you can just replace them with a computer, and that problem is the AI now comes in and further optimizes their optimization. So if you've ever walked into a VW factory in your life, you know what it feels like to be to truly be a number. You are a number. You are in this incredible system. It is just so much bigger than you or anyone else. It's just so perfectly optimized, and any kind of wastage is just pounced upon through an assortment of ISO systems and just innumerable efficiency measures and consistency measures. So believe me, they will have no human employees if given the option, because the robots don't answer back, they don't sleep, they don't tire, they don't unionize. So it's but obviously now that sucks to be a citizen and find that out. But as a shareholder, that's some good stuff, because you know you're going to go straight up. You got deflation. The real thing about AI, the force that it brings to the world, the most powerful force is the force of deflation, because it will. Everybody tells you about how inflation, ruins your life and everything, but deflation is happening with AI. you don't have to pay a computer programmer 60 grand a month to design computer programs anymore. You can just get the AI to do it for free. You don't have to go to the GP for a 500 rand fee so he can tickle your knee and tell you you've got a cold. So the cost to do business is dropping. And that's very good for a consumer. And it's very good for a shareholder because it expands margins. So from the perspective of the role players of the company, customers, management, shareholders, with the exception of employees, it's very good. And it's true of millions of different things that it's bringing the costs down on. It's not just Amazon. I mean, it's every single company is obviously experiencing enormous savings in various ways. And not needing as many specialists and that kind of thing, not needing as many lawyers. It's a better world. Okay. But yeah, it's going to hurt the blue collar worker type. But ironically, it's also going to hurt the very well educated individuals. People who thought they had some sort of a barrier to entry through their studies are going to find out that their skills are very easily replicable by these things. I've seen it done in many different fields and in different areas. As we go on, it's absolutely terrifying, actually. But I'm just fascinated by what will emerge from it. I believe it will be less work all around. As silly as that sounds. It takes a lot of menial tasks from people and expedites a lot of, it also improves communication. You know, you might want to write some kind of a motivation letter to your staff for a incentive savings plan, and maybe you're just not good at doing that, and this thing will find the words and it will actually literally see more people ultimately at the end of the day join the fund. So, you know, if that's constantly happening, the speed of our development will be exponentially faster, with the avoidance of wasted time and repetition and irrelevant information. You just get to the answer faster, so you can move on. And importantly, you can find out all the ways not to do something much more quickly. A similar line of thinking of avoiding the bad shares. It helps you stay away from the things you don't need to get involved in, so you can carry on focusing on the things that you should. Very useful for companies who want to be efficient. That's their job. They've got a profit motive. They're not like government, who's got a theft motive. I mean a collective motive. All right, so we're going to go Walmart, another consumer-facing company. Obviously a massive company. It's been owned by the same family for, well, since it was founded. That really is an absolutely enormous economic force, this one. You can see it's very much powered by inflation. This is a characteristic of retailers. They like inflation. And we've experienced a lot leading into this. Again, you have your tariff collapse here from earlier in the year. And then you've got a quick recovery. And now we look like we're entering into the region of the old highs. But again, another retailer, unlike technology, this company is on its way up to the highs, but has not yet passed the highs. Great company, but yeah, limited room for growth on this one, since it's already by far the biggest retailer in America, except for Amazon. Okay, then everybody knows Coca-Cola. Coca-Cola, the monster. This is Warren Buffett's favorite company. It's one of he's the biggest shareholder in the company. Back in the 80s, I think it was, they changed their recipe, which wasn't a very bright move, and the market basically wiped them out as a result. At that time, Warren Buffett bought about $500 million worth of the company. You can only imagine what that must have felt like in 1985. And now it's worth hundreds of billions. And he's the main shareholder, and he's a lifelong fan of Coke. Although, Coke's doing okay, but I mean, you can see here, it's not doing so great. It's gone from 22 to 71. Okay, that's awesome, but it's taken like 10 years to do it. So it's a very consistent stock, but it's not an Nvidia shooting the lights out from a percentage term perspective, This is largely because even over the course of my life, I've really found that companies, well, people, and then particularly governments have turned against sugar. Whether you like sugar or not, they really have. And they've imposed a number of global taxes, and they've imposed a number of requirements on these companies that impose rules on their fake sugars, and it just increases their costs and makes their life more challenging. And, the zeitgeist of the people is just changing. People are wearing like sports casual. They're all going to gym. They got the idea they got to be healthy. And I mean, this stuff is sugar water. They own a lot of products, like a lot more than just Coca-Cola. They got a completely dominant position. Coca-Cola has some incredible characteristics as a product. It has it's actually got such an enormous amount of goodwill value. It's probably the most valuable goodwill brand in the world. Coca-Cola is an interesting substance because Coca-Cola only remains in your mouth for about 5 seconds. It has that characteristic. It has the shortest mouth duration of any consumer product. So if you eat a steak, the taste stays in your mouth for a few minutes, but Coke instantly vanishes. That's what motivates people to drink more Coke, and that's why Coke outsells Fanta. Coke taste memory, but very short one for the Coke. So it's just an amazing product. It's been many things over the years. Things that would terrify you that they used to give babies, but yeah, they don't anymore. So yeah, now it's just the other bad thing, sugar. Okay. Yeah, guys, we've got a few more in the goodwill, consumer goods and retail, but we'll just take a little break here quickly, and then yeah, let's take about a 15-minute break or 10-minute break, and then we'll come back to each other. Okay, guys, we're back. Let's get everyone a chance to settle a bit there. I see that I'm actually falling behind here. So far, we've done like 10 of these things and I've got half the time left. So let me just give you a little bit more of a quick rundown. So we ended off at the Coca-Cola company last time, the world's largest beverage company, manufacturing, marketing, and selling non-alcoholic beverage concentrates and syrups. Then we have Home Depot. It's the largest home improvement retailer in the United States. It sells tools, construction products, and services. So it's kind of like a Cash Build or a Midas, or like a Macro, but super big. And in America, they do a lot of building. They build most of their houses out of wood, that kind of thing. So, and they've got a lot of different types of terrain and environments. Here you can see this company has basically gone nowhere since 2021. This retailer has really suffered. It's, I mean, it doesn't really look like it suffered, but I speak from like a relative basis compared to the Nvidias of the world, which are like up here on the chart. The retailers have not been an area where you found a lot of alpha in the market. So again, we've covered Coca-Cola, Walmart, and Amazon and Home Depot. None of these charts are shooting the lights out. They are consistently performing. They are adding value. They move up always. They have their hard times, but overall it's a bottom left, top right. But it's not super profits in a very short period of time. You know, it's just a consistent upward movement on the chart. Whereas something like Nvidia, for example, is doing something like at a far higher, at a far more impressive vector. This company also has a large number of imports, etc. So tariffs again, causing pressure there. And we've got McDonald's, personal least favorite of mine as far as their food goes, but fantastic share. It's done just so well. McDonald's is it's not actually a company that sells hamburgers. It's actually a property company, and they own more property than any company in the world. So they really are an incredible business. They got a heck of an origin story. It's too long to go into detail, but yeah, they've made movies about the origin story of this company. And yeah, it's just incredible how well it's done. And it consistently just delivers a good product, or a product, let's call it, to the public. And it's extremely popular all over the world. Also, remember, we are still talking about consumer goods and retail. So this is all stuff that faces the normal customer. Like, you don't go buy microchip GPUs for your server farm from Nvidia, but you do buy McDonald's. You do go to Home Depot, you drink a Coca-Cola, you walk into a Walmart and you order something on Amazon. That's what you do. And then another thing you do is you buy shoes. Everybody knows Nike. How's that chart looking? Now, Nike has had a very, very, very hard time lately as a result of a number of new laws that have been enacted in the East that have affected their sales. They also changed the way that they marketed their brands and how they licensed them out. And that made some of their original licensees very angry, and it was just shockingly bad for the business. Now, if you think about it, this was once the chart of Nike. So Nike was an absolute masterwork of value creation over the long term, up until just a couple of years ago, and then, whoa, doom. Now the question is this forever? Or is this a rare opportunity to buy what could be, again, like Coca-Cola, could be argued to be the world's most famous brand? Along with Coke, maybe Tesla, a few of these kinds of companies. So this company's drawdown was from 180 down to 50. So it lost 75% of its value over the course of only 2 or 3 years. As you can see, it actually came out with earnings just this week or last week, and they weren't great, but they weren't terrible. So the share price went up 15%. And it shows you how, like, many people will look at stocks and they'll say, well, you know, the earnings were good and the share price went down. It makes no sense. Well, the question is, what's priced in? So the earnings weren't great, but they weren't Armageddon. And the market had anticipated Armageddon. So this could be a meaningful turning point in the company, because this chart, this most recent price movement is based on a fundamental variable, not pie in the sky. It's not based on random chart movements or overall market bullishness. This is actually the result of the fact that the earnings came out of the company and they were better than expected. So that's always a nice, if you're going to give, if you're looking at a support or a resistance level or an entry point in the company, and you're trying to determine, you know, how much credit you should give that particular data point, if it's based on something truly fundamental, like the company's earnings literally came out and they told you, that you can give a little bit of a higher weighting. So why did this breakout fail? Why did it turn out to be down again after that? Maybe this one will work. Maybe this one was caused because traders thought that it had hit some kind of support level, but that was just pie in the sky. Whereas this one is actually a fundamental reason for a shift in sentiment in the company over time. You can't see that if you just look at a chart. But if you have a general sense of the fundamentals of the company and the recent announcements, you don't have to be super cutting edge. It's not about like you need the latest news so you can do the smart thing. It's not like that. It's just you want to have a general idea of what's caused the primary shifts in the company's price movement. Like what happened there at the very top? Did something happen? Like, did someone get shot, or what happened there? You know, you don't want to like enter a position and not have any idea why that happened. Maybe someone came out and said that these people were putting, you know, asbestos in their shoes and had killed 10,000 people. Like, that's not a company that's got a very sustainable business model. So you might want to stay away from that. But here it's telling you, okay, you've got a situation where the company wasn't doing well for a very long time, for a very sustained way, in a very negative, heavy, obviously very bad way. Yeah, boom, it's just literally halved in value. So it was imagine being in the share during that time. Imagine having your money in there. This was a painful experience for these guys. So by the time we get here, you get this strong upside movement off of earnings which weren't even necessarily that impressive. It's an indication that reality versus expectations on Nike are very negative relative to the reality. Even if the reality is itself negative, the expectations are more negative. Okay. And it is the relationship between the real and perceived price point that actually determines your profits in trading, not the actual announcement or actual polarity or anything. It's just the market's always trying to put the price from the place they expected it to be to the place it should be. And they're not often the same place. Okay, then you get Procter & Gamble. Procter & Gamble makes stuff like, like Domestos style stuff and, like detergents and cleaning supplies and personal care products and that kind of thing. You can see here that they are also a consumer-facing company, and they've done a little bit better than the other ones because maybe they have a higher end market with face creams than McDonald's burgers. But still, it's not quite an Nvidia. It's not quite a Palantir. And you can look at these companies and get a sense of the American consumers' disposable income levels, etc. Obviously, very healthy still. I mean, don't get me wrong. It's fantastic. I just mean, relatively speaking, the sector's, it's been okay. Then you get Walgreens. Now, Walgreens is like, it's like kind of like Clicks or Dis-Chem in America. You could see there, you'd think no one was sick in their country. But yeah, this one has had an absolutely shocking time. It actually has exceptionally good fundamentals. If you look at the share price, complete collapse into high volume, and now lots of buying here. Huge buying on the volume. Now on the volume, it is not being reflected in the share price, but you are seeing the volume here. Think about how much, if this is representing your volume, how much cumulative volume from this region would be required to fill that bar in surface area. So in the matter of maybe a few months, we've traded the equal volume of annual volumes of other years. So this one is very interesting. It is very likely to soon experience a large movement. Is that ambiguous enough? But it will. The Walt Disney Company. Okay, everyone knows the Walt Disney Company. The Walt Disney Company. So this one had a very hard time for a number of years. Their films originally, basically everything since Endgame has been a bit of a fail. They recently struggled with Snow White. Yeah, pretty much nothing worked for the last few years. Their creative team has been largely quietened finally, and hopefully they're now moving in the right direction. They've got every conceivable franchise, everything from X-Men to Spider-Man to Avengers to, every Marvel, all of it. Disney, they've got Star Wars, they've got ESPN, they've got it all. It's just the most incredible portfolio of assets in the history of the world, in my opinion, this company. But their management just seems to self-destruct for the last few years. So they need to, pivot, especially from the market's perspective. The market's very angry with this company. It's been very angry for a long time because they know the assets that this company has, and there's absolutely no reason whatsoever that the Disney company should be at the same price that it was in 2015 right now. I mean, that is just mismanagement of assets. And that is what we're thinking. And that's why the share got priced down so badly. These guys should literally print money from the moment they wake up in the morning, and it should be a no-brainer. But anyway, management teams are fleeting and the company is forever. So this company will be good in the future, I'm sure. And it seems to have come right a little bit now. But yeah, it's unfortunately it's missed the whole rally, you know, over the course of the last 5 years. Just pouring money into films that have been no success. Also, they're desperately trying to compete in the online sort of Netflix, Amazon Prime, Apple TV realm, and they're losing money hand over fist. So it's not good at all. And they really are turning out to be the loser in that war of streaming. The winners, by the way, are undoubtedly Amazon Prime and Netflix. Apple TV is not doing too well, and Disney's a catastrophe. Plus, they recently raised fees, which obviously isn't great, into a catastrophe. Anyway. Okay, so we finished with the consumer-facing folks. Now we're going to rapid fire through financial services. Okay, so American Express. It's a global financial services company best known for its credit card, charge card, and traveler's check businesses. So this company is literally a money machine. It has produced so much money for its shareholders over the years. It's just beyond. It's basically the financial infrastructure of the planet. They facilitate international payments. They are fully integrated into the world systems, that interbanking systems. They are fully entrenched. They're an extraordinary business. And there you can see they just carry on. No problem. Think of it like a big online bank. International bank. Then you get Goldman Sachs. Credible business, obviously. These guys once came to Warren Buffett in a time of need in 2008 when he was sitting in a restaurant with his grandchild or something, eating breakfast. And they asked him for $5 billion and he gave it to them, and he's held it over them for the last 20 years as a result. He's had power over these bankers as a result of that debt at the time. He even outwitted these guys. This is a massive investment bank in America. It's a leading global investment institution. It's got trillions of dollars under management. They do an innumerable number of financial services. Remember the difference between you get two kinds of banks. Like when you think about banks, we don't really have the one of them here in South Africa, but you get retail banks like Absa or Bank of America, which is like America's Absa. They do all the home loan kind of things. And then you get F&B is a retail bank. Dana Bank's a retail bank. And then you get investment banks. Because in the old days, they used to have a situation where banks used to speculate with people's money. So eventually government got so angry with them making themselves go bankrupt from messing around, that they said, okay, if you're going to do the kind of messing around stuff, you have to do it separately from the retail stuff so that, you know, the widows and orphans don't lose all their money. So now you get retail banks in America and you get investment banks. When you hear banks like Goldman Sachs or JP Morgan, those are investment banks. And then if you think about, you know, Bank of America, like I said, or an Absa or an F&B, they're just normal We have Investec in this country, which has an investment banking division. So that's Goldman Sachs. And now, interestingly, this quarter, I've noticed on the market itself that banks in America have been the best performing of the recent stocks, or the recent price movements have been banks. There seems to be a theme entering the market. And I mean, I watch over the months, you get this theme is this IT companies, or it's this, or it's that, or it's specifically against oil companies, etc. And there seems to be some speak about, particularly investment banks are becoming a little bit more favored in the market for now. It's largely based on forward projections of interest rates, because they affect how much money banks make. The difference between the interest rates and the ultimate let me just okay, sorry. Okay, let me just get back to JP Morgan. Sorry, I just got to move on, guys. I just realized I'm running out a bit of time here. Okay, you see how now you've gone from Goldman to JP Morgan, and they're identical. So it didn't really make a difference which one you bought, because you were maybe more considerate of the sector you were buying. So again, because the theme of these companies is up, the whole sector just goes up. And recently it's been pretty strong. Okay, quickly we move. Travelers. Okay, TRV. Again, this company is an American insurance company, so it's in financial services, but unlike JP Morgan and Goldman Sachs, it's not an investment bank, it's an insurance company. This would be the equivalent of something like Sanlam in South Africa. They also do, they provide insurance on property and insurance products for people. Remember, in America, there's no medical aid. They have insurance for their medical requirements. Then obviously, if we look at, I just want to actually open AXP again, which is American Express. And then as we transfer into Visa from American Express, you can see both of them are at all-time highs. Again, Visa is a money printing machine. It always has been. It's the most extraordinary company, fully integrated into the system. The only one of these sorts of companies, it's not on the competition, but I'll show you anyway. The one that's a problem is PayPal. That one, of the whole group of shares in that sort of sector. Now, PayPal's too small to qualify for the Dow, but I just thought I'd show you how, obviously PayPal and MasterCard and Visa, they don't do exactly the same thing, but they are involved in a very similar sort of area, obviously, of internet payments and international payments, etc., and being escrow accounts and these kinds of things. You get the sector wrong, or even the subsector wrong, and you can completely miss the rally. It's just it's important to know what theme the market's working with at the moment. Over and above the traditional things they'll tell you about, know your fundamentals, know your charts. That's all fair and well, but you can't like sit and build your masterpiece sculpture if there's bombs raining down around you. You need to think context, and then contextually you go into the investment, having eliminated certain things. Now let's get to the more interesting stuff, because the sectors that I'm going to cover now as quickly as possible, are the sectors that have performed the worst in America. We've seen now that consumer-facing financial services and technology have performed well. So what's performed badly? Okay, so Amgen is an enormous company. They're a biopharma company. You can think of them like an Aspen in South Africa. And they have they've actually done okay for the healthcare sector, but as you'll soon see, the healthcare sector hasn't performed very well. Now, this is done okay, but you can see that the trajectory here it's not very steep, you know. I mean, you haven't shot the lights out, you know. It's okay. It's obviously a decent big business. But you know, big whoop. There's not much to do there. So it hasn't been terribly exciting. Let's look at J&J. Johnson & Johnson has gone sideways since 2020. Again, had you been in the healthcare sector leading into, you know, the last few years, you wouldn't have made any money. Even though, and then I could have asked you, I would have said, hey, Johnson & Johnson, a good company. You would have said, oh, it's the best company. Half my shampoos, my baby uses, everything. It's Johnson & Johnson. Half the stuff in your cupboards, Johnson & Johnson. But for some reason, this sector, not so hot. Didn't do so well. Then you've got Merck, which is a huge pharmaceutical company. They specialize in vaccines, which have been a hot topic of late. So you can only imagine that leading into the whole COVID story, we had epic upside price movements on all vaccine producers. And then after COVID, down they went. So that's kind of a great example of how themes in the market affect things and how you could have asked yourself, is Merck a good company? Of course it is. Giant pharma company, lots of brains, lots of assets, lots of money. But in the context of leading into the COVID crisis, it was very popular to buy this stock. So you could have bought any Pfizer, you could have bought GlaxoSmithKline, you could have bought any of these numbers of these companies, and you probably would have done fine. But had you owned any vaccine producer since COVID, you have lost. I don't care how good a trader you are, you lost. The only good trade would be to have not bought it, and then to maybe purchase it now, if you're looking at it and you're determining if this is the point. But nothing up till now was a good idea. And the same is true of many different stocks on the index that relate to this sector. So yeah, you can see, obviously by this point, 2015s, no one knew about it. It was just a normal good company making its vaccines, normal stuff. And then boom, COVID. Whoa, it's going to be Christmas. Blah, blah, up and then down. And I mean down with some proper vengeance. Look at that. It's gone from 132 down to 75. So it's halved in price. You know, since 2024 now, after they had concluded all of their sales and their contracts that were resultant from the pandemic. And now maybe things are going to go back to normal. Who knows? I'll actually show you another one, Pfizer. Just a second. Okay. Another one that's been absolutely vaporized, you can see here, is Pfizer. Simply because it was in the same sector. It experienced exactly the same movement, experienced exactly the same movement down. It doesn't matter whether you could have bought healthcare, you could have bought this sector with a dartboard. You would have lost. Different sector with a dartboard would have won. I'm just trying to emphasize how impactful that can be. You can be the best trader in the world, but if you're in the wrong context, a bottle of water, it costs you R1 at the spa and $4 at the gym and $7 on the plane. It's important what context you're in. Okay. All right, then United Health. Now, I know there are a few of you who are brave enough to have bought this. This stock has had some serious adventures of late. Round about it over there, a random terrorist shot their CEO in real world, and he died. And then they came out with a number of disappointing earnings sets, and the share price absolutely tanked. This thing is sort of the Discovery of America. It does most of their medical insurance. It's their biggest healthcare provider. Not to be confused with hospitals and that kind of thing. These people are the financial services of the hospital. So they're like Discovery. They're not like Netcare or Life Healthcare. And they obviously, I mean, before that, they were, like your standard, anyone who's got medical aid knows how much money these people are making out of you. Okay. So that's your healthcare sector. So you can see there that is definitely a cheaper sector. It's by far the cheapest sector we've looked at so far. The question is, will it keep going down or will it go up? So the question is, do you want to buy your Nvidias because you think their rally will continue and their strength will continue to happen? Or will you buy these because you think they're about to turn around? The irony is that the continuing strength is always more probable than a turnaround. But should a turnaround ever occur on that share, you will make more money on the turnaround than you ever would with continuation. So one is determining whether one wants to make money more probably or higher volumes of money, but then also higher volumes of risk. Okay, then we got 3M. MMM. Kid you not, that's its ticker. Okay, it's actually called Triple M. 3M. It's a diversified technology company that applies science and innovation to make real-world impact on people's lives globally, producing a range of products, adhesives, and medical products. So they do all sorts of cool stuff, basically just serving society. We don't have to give them too much attention. You can see that the stock price performance is quite strong over the. In fact, I actually, yeah, that's quite a strong performer. Wow. Then we've got Boeing. By the way, the sector that we're in right now is called industrials and materials. So the first one was 3M. Now we'll do this one. Boeing. Okay, Boeing's had a really, really hard time of late. Because the whole thing with their planes falling out of the sky and everything. And then also when they find that the stuff's been put together with like sticky tape and some bubble gum and doors falling off and, it's not ideal. So looks like they're coming right there, though. I mean, if you look at it, they're looking pretty strong. So also, this company has some of the strongest tailwinds in the world because Boeing, if you think about it, like say, for example, I don't know what the exact stat is, but maybe it's like 90% of adult Americans have been on a commercial airline and had a flight to another city even. Okay, maybe another town, doesn't have to be another country. But they went to an airport, they jumped on a plane, and they flew somewhere to meet their cousin John or whatever. In China, it's like 15% of the population have done that. So I personally don't like airlines as a business model. A Delta Airlines kind of thing. You know, I don't buy shares that run airports or shares that run airlines. But again, if you don't try to dig up the gold, just sell people the spades. Boeing has some of the biggest, this wasn't on purpose, some of the biggest runway you'll ever find for a future business. Because of the number of people that have simply never flown. And they will get their business model right. They'll get they fired their CEO, etc. They're busy in the process of fixing all the issues that they had. That's what they do. That's what they do best. So I think they'll probably get that right. And then there's a lot of runway for growth in this business because of just the number of people that have never flown on a plane. So yes, this is a really awesome business for the long term. Whether it's great for the competition right now, I don't know. Maybe not. But it hasn't even broken to new highs yet, so that's okay. And you've got caterpillars, all those big yellow machines that you see building the world around you, cranes, like farm equipment. You can see here that they've been building a lot of stuff, obviously. Again, just another great business that I didn't actually know this company's done this well. I haven't looked at it in a while. But yeah, they are infrastructure company, the world's largest manufacturer of construction and mining equipment, diesel, natural gas engines, industrial gas turbines, diesel electric locomotives. These guys power industry. They're pretty cool. Everybody knows the brand. I mean, how cool a brand must you be if you make like boring farming equipment and everyone knows who you are? I mean, that's awesome. Here we got Honeywell. These guys do things like aerospace systems. Look at this. I mean, when everybody's fighting, you best believe these things are going to be doing okay. So they do just a number of things. They have a diversified technology and manufacturing company that produces a variety of commercial and consumer products, engineering services, and aerospace systems. Then we have Sherwin-Williams. Okay. This company makes paints and coatings and that kind of stuff. Not terribly interesting. I won't give it too much time, but yeah, it's obviously a good business. You can see that every single company in the Dow has a very strong tendency to the upside. Whether we say they've performed well or not, these companies are undoubtedly making fortunes of money, and they're the best companies in the whole world. And that's why they're on this index. So even if you do nothing in your life but buy the Dow over the long term, if you held this for 20 years, like I say, you don't have to be specific. You just buy the index, keep it in the bottom drawer, and you'll do very well. Now we're going to move on. Okay, so did you see how we have like different numbers of shares in each subsector in the Dow, right? So we had a lot of technology. We had a lot of consumer goods and retail. We had a fair number of financial services. We only had 4 healthcare companies we've got only 5 material companies, and then we've got 1 telecommunications company, Verizon. Oh, sorry, get rid of this. We've got only 1 communication company, Verizon. And it hasn't done very well. Well, it's done well off this base, but it hasn't done well overall. So how many energy companies have we got in? 1 energy company, which is CVX, which is Chevron, which you've obviously heard of. Biggest oil company, like you'll find. But again, only 1. So if you, here's the trick with the Dow. It's something that you will now know and no one you know will know. If you look at the Dow and you see which sectors comprise the largest percentage of the Dow constituents at this time, given the fact that the Dow's constituents change over time. You can see here that oil and energy as well as communications are not highly represented in the Dow at the moment, and that is a strong indication that those sectors are currently cheap. And as the other companies have come to dominate the Dow, you can see that these companies like energy and telecommunications and even materials to a degree haven't been experiencing great price upliftment lately, or they themselves will have kicked someone else off the Dow. So it's very likely that in the coming years, the underperformance in the oil and energy sectors, particularly overall energy, because that includes all forms of energy, as well as, because even green energy has absolutely suffered lately as an investment on the market. So all forms of energy. It's not just because you might have the view that oil is a thing of the past. Whether you believe that or not, the solar panels are crashing as well. So it's energy that's going down. Energy, natural gas, oil, all the ethanes, methanes, etc., chemicals, etc., as well as healthcare. Those are the 2 sectors at the moment that could be considered cheap. Someone could say, yeah, but NVIDIA is still cheap because they've got 10 times the growth coming in the future. Okay, fair enough. But right now, it's probably oil and healthcare that are cheap. Just something to keep in mind. Okay, well, yeah, that's about it. We actually have covered the whole index now, so that should give you just a general idea of everything. Always think from an index perspective and from a sector perspective, and then start your analysis. And you're going to kick butt. You guys are doing really well. I mean, making proper money on that, but based on what I've seen here, and it's awesome stuff. So well done to Varsity College again for the initiative, and to Megan for all of this admin in the background that runs these systems. And good luck, guys. Be around if you ever need anything.
Okay, if there aren't any questions, I'll wait a few minutes. But otherwise, have a wonderful Saturday. Thank you so much for joining us. And I'll make the YouTube videos available as soon as possible. And yeah, have a wonderful weekend. Thanks so much.